Right now, we're watching one of the absolutely most fascinating divides in the entire financial world. On one side, you've got these trillion-dollar market predictions promising just endless digital wealth. But on the other side, well, there's the unforgiving, gritty reality of retail trading, where a single platform glitch can literally wipe out your entire portfolio in seconds. Let's look at this massive clash. Which really leads us to the million-dollar question. Literally, right? Are these massive million-dollar market predictions actually executable? It's remarkably easy for an analyst to just draw an upward arrow pointing straight to the moon, projecting these massive future valuations. But what happens when you, a retail trader, try to actually execute a trade at those theoretical targets? There's a massive mechanical difference between what a macroeconomic model predicts and what actually happens when human beings interact with digital trading interfaces during moments of extreme market stress. Okay, let's dive into this with one of the most prominent voices in the space, analyst Tom Lee. His baseline 2026 prediction for Bitcoin sits at a staggering $150,000, scaling all the way up to $250,000. He even pulls Ethereum up to an astonishing $12,000 mark. I mean, these are exactly the kinds of numbers that ignite absolute retail euphoria. But to really grasp them, we have to look at the engine he actually believes is driving the whole thing. This euphoria is completely rooted in what's known as the crypto spring thesis. This isn't just about day trading momentum, no. It's the belief that we are standing right at the starting line of a massive, secular digital bull market driven by pure demographics. Think about the literal trillions of dollars held by baby boomers right now. As that immense wealth transfers over to millennials and Gen Z, generations that basically grew up on the internet, the logic dictates that a tidal wave of capital will inevitably flood into digital assets, driving prices straight up to those astronomical targets. And the timeline for this, it's actually surprisingly specific. While we're sitting in the early cycle right now, the absolutely critical phase to watch is the mid-year wash test. Analysts are actually anticipating a sharp 15 to 20% market drawdown here. But rather than panic, this dip is theorized to be the ultimate launchpad, like a tightly coiled spring compressing right before a massive wealth-generating rally to close out the year. It sounds incredibly compelling, right? Almost like a guaranteed roadmap to generational wealth. Well, that's the euphoric theory anyway. But then there is the harsh, cautionary reality of the retail experience, something perfectly captured by what we're calling the 10-10 trust gap. Because for thousands of traders, the bright optimism of that crypto spring violently collided with the reality of the October 10th, 2025 crash. And the real importance of that date isn't just the massive market drop itself, it's the terrifying reason why retail traders were left completely helpless to stop their losses. See, that October 10th crash exposed severe infrastructure failures that simply do not exist on those pristine macroeconomic charts. This wasn't a case of traders getting too greedy with leverage. It was a cascade of technical disasters. We saw critical Binance platform glitches and these catastrophic Oracle failures, where the crucial external data feeds, the ones actually pricing the assets, just completely stopped updating. Imagine the visceral stomach-dropping horror of knowing exactly how to save your portfolio, but you're just staring at a totally frozen screen. The sell button is literally just gone. The irony of advanced digital wealth being wiped out because a basic piece of web design vanishes is pretty dark, isn't it? And this brilliantly illustrates the gaping structural flaw in digital asset trading today. When you contrast centralized crypto exchanges with traditional markets, it is completely night and day. During periods of high volatility, crypto exchanges wildly lack the fundamental circuit breakers designed to actually protect investors. It creates this highly manipulative environment of fake liquidations, where glitchy data triggers massive automated sell-offs. But traditional markets, they're built on heavy regulated safeguards. They rely on concrete, real-world data feeds that don't magically shatter the second trading volume spikes. Because of this massive trust gap, we're witnessing a genuinely fascinating migration. Experienced retail traders, totally exhausted from fighting glitchy platforms, are pulling their capital out of digital assets altogether. Instead, they are pivoting directly into traditional metals, finding refuge and real opportunity in copper, silver, gold, and palladium. It's kind of funny when you really think about it. They're trading the futuristic digital promises of the crypto spring to basically go back to digging shiny rocks out of the ground. But you know what? The logic here is brilliantly grounded. This isn't some migration based on speculative hype. It's a flight to tangible value. The demand for these metals is driven by undeniable physical realities, specifically the global artificial intelligence boom and massive infrastructure expansion. AI data centers literally require immense amounts of copper and silver for electricity and cooling. Palladium has massive industrial utility. And gold? Well, it remains the historic standard of value. These traders are choosing assets backed by actual physical utility over theoretical demographic charts. What's really fascinating is how they're extracting profit from these physical markets. They aren't just buying and holding rocks, they're using systematic superiority. Take the dynamic grid strategy, for example. It's a highly systematic trading method designed to capitalize on the natural regulated volatility of commodity markets by setting a grid of buy and sell orders. It actually allows traders to systematically profit from the market's natural price zigzags. And because these traditional markets are robust and highly regulated, traders can deploy these complex automated strategies without the looming terror of a platform glitch just wiping them out overnight. So, what does this all mean? It ultimately comes down to execution and integrity over pure hype. Trillion-dollar targets and massive macroeconomic predictions are entirely useless if you cannot actually execute your trade reliably when the market inevitably moves. While some analysts continue betting on a demographic-driven return to crypto euphoria, seasoned traders have realized something crucial. The reliability of the commodities market simply provides a vastly more sustainable and, quite frankly, enjoyable trading environment. Which leaves us with the ultimate divide we've explored in this explainer. Will you bet your capital on the glitchy moon, crossing your fingers and trusting the platform will actually work when you finally need to cash out those massive macro targets? Or will you trade the grounded reality, focusing on solid execution, regulated safeguards, and tangible utility? It is arguably the most important question facing retail capital today. Thanks so much for joining me for this explainer. Keep learning, and I'll see you next time.